In today's lesson, we're diving into Chapter 6.1 Economic Issues, where we uncover how the wider economy affects every business decision. First, let's look at some key terms. GDP, Gross Domestic Product, is the total value of all goods and services produced in a country in 1 year. For example, if Vietnam produces more electronics, textiles, and services compared to last year, its GDP grows. Inflation is a sustained increase in the general price level of goods and services. For example, if goods prices rise every month, people must spend more to buy the same items. Unemployment is when people are actively looking for a job but cannot find one. For example, if a company closes and workers cannot find new jobs quickly, the unemployment rate rises. Business cycle. The business cycle describes patterns of fluctuations in a country's economic activity. It has four main stages: growth, boom, recession, and slump. Each stage affects spending, production, jobs, and business performance in different ways. The first stage is growth. The growth stage occurs when GDP is rising steadily. More people have jobs, so spending increases, leading to higher demand for goods and services. Businesses usually see higher sales and may expand production. Living standards improve because people have more income. This stage generally creates a positive environment for most businesses. Next, boom. A boom happens when the economy overheats. Demand becomes extremely high and firms may struggle to keep up, causing prices to rise quickly. Skilled workers become scarce, so wages increase, raising business costs. Businesses often raise their prices to cover these rising costs. Although sales remain high, uncertainty may begin to grow due to inflation. For example, during China's boom period, construction companies struggled to find skilled labor, causing wages and project costs to rise sharply. A recession occurs when GDP falls for a period of time. Customers reduce spending, which leads to lower demand for many products. As revenue drops, businesses may cut jobs, increasing unemployment. Many firms focus only on survival rather than expansion. Confidence in the economy becomes weaker. For example, during the 2008 global recession, many car manufacturers reduced production as demand collapsed. And the last stage is slump. A slump is the worst stage of the cycle. GDP remains extremely low, unemployment is very high, and many businesses shut down completely. Customers buy only essential goods, causing severe drops in revenue. Economic recovery becomes very slow. Governments usually interfere heavily at this stage. Now let's look at impacts of change in employment, inflation, and GDP. Change in employment levels affect both customers and businesses. When unemployment is low, customers have more income and businesses can sell more. Rising inflation increases business costs, forcing firms to raise prices, and customers may switch to cheaper alternatives. When GDP increases, the whole economy grows and businesses benefit from higher demand. But when GDP falls, spending declines, profits drop, and firms may reduce investment. Governments aim to keep the economy stable by targeting four key objectives: low inflation, low unemployment, healthy economic growth, and a balanced level of exports and imports. Inflation is the sustained increase in the average price level of goods and services. Governments aim for low inflation because stable prices help businesses plan their future costs and revenues. Inflation also influences people's real incomes. Real income refers to how much goods and services people can buy with their wages. So when prices rise faster than wages, real incomes fall, meaning people feel poorer even if their salary stays the same. When inflation rises too quickly, the cost of raw materials increase for businesses. Many firms are forced to raise prices, and customers may buy fewer products as a result. Lower sales often lead to lower revenue and profits, which can reduce business expansion plans. Workers may also demand higher wages to keep up with rising living costs, adding even more pressure on firms. Next, low unemployment. Unemployment occurs when people who want to work cannot find suitable jobs. Governments aim for low unemployment because more employed people means higher incomes, more spending, and a stronger economy. When more people are working, the government also spends less on unemployment benefits. High unemployment reduces customer spending because families have low disposable income. Disposable income is the money people have left after paying their taxes. It is what they can spend on goods and services. This leads to falling demand for many goods and services, increasing pressure on businesses. Companies may experience lower profit and may even need to reduce production or delay expansion. Economic growth. Economic growth happens when a country produces more goods and services than before. This leads to more business opportunities, more jobs, and higher levels of disposable income. When disposable income is higher, customers spend more, increasing business revenue and profits. When economic growth slows down, incomes fall and people buy fewer goods. Sales and profit decrease for many businesses, and companies may reduce investments. Lower growth also means less competition in markets as some firms struggle to survive. For instance, many European countries saw slower economic growth in 2020, which led to reduced spending and weaker sales in industries such as tourism and retail. And the last one, balance of payments. The balance of payments shows whether a country is selling more goods abroad than it's buying. If exports are higher than imports, money flows into the country. If imports are higher, money flows out. A balanced level of trade is important because it helps keep the currency stable and supports local industries. If a country imports much more than it exports, it may run out of foreign currency needed to pay for imports. The national currency may fall in value, making imports more expensive. Local industries may lose jobs because they cannot compete with cheaper foreign goods. Over time, a large deficit in the balance of payments can reduce the country's overall income and economic growth. A severe trade imbalance can also reduce investor confidence. Next, we're going to look at government economic policies. Governments use several economic policies to manage the economy, including fiscal policy, monetary policy, and supply-side policies. Each policy influences business differently. The first one, fiscal policy. Fiscal policy is any change in tax rates or government spending. There are a few types of taxes. Income tax is a tax paid on individuals' earnings. When income tax rises, people have less disposable income, so they spend less on goods and services. This can reduce business sales and lower revenue. Profit tax is charged on the profits that companies make. When profit tax is high, businesses keep less retained profit, making it harder for them to invest, expand, or purchase new equipment. Indirect taxes such as VAT or sales tax are added to the price of goods and services. As these taxes push prices higher, customers may stop buying more expensive products, reducing demand. Import tariffs are taxes placed on goods imported from other countries. They make foreign products more expensive, encouraging customers to buy locally produced goods instead. Import quotas. Import quotas limit the number of goods that can be imported. This protects local companies from excessive foreign competition and helps domestic industries grow. Now let's look at impact of high taxes. High taxes reduce the amount of money consumers and businesses can keep. Customers can spend less, lowering business revenue. Companies also retain less profit, making investment harder. Some firms may raise prices to cover rising costs, which can further reduce demand. Overall, high taxes slow economic activity and business growth. Second part of fiscal policy is government spending. Public expenditure refers to government spending on services like education, healthcare, transport, and infrastructure. Better roads and transportation make it easier for business to operate. Spending on education improves the skills of the workforce. Public sector projects can also create jobs, increasing incomes and spending in the economy. Strong government spending can stimulate business growth across many industries. Impact of public expenditure. Government spending helps businesses in many ways. Construction companies benefit from building new public facilities. Better infrastructure reduces transport costs and delays. Grants can support startups and small firms. With more public sector employment, customers have more income to spend. As spending increases, businesses across the country benefit from higher demand. Overall, strong government spending can create a more stable and supportive business environment. Next, monetary policy and interest rates. Monetary policy involves changing interest rates to influence borrowing and spending. Interest rates represent the cost of borrowing money. When rates are high, loans become expensive and both consumers and businesses borrow less. When rates are low, borrowing increases and spending rises. Monetary policy is used to control inflation and stabilize the economy. Impact of high interest rates. High interest rates make loans more expensive for businesses. This reduces investment because companies prefer to avoid taking costly loans. Firms with existing loans face higher repayment amounts, which affects cash flow. As borrowing becomes harder, many businesses delay expansion plans or avoid purchasing new equipment. Consumers also reduce spending when interest rates rise. Higher loan repayments means families have less money available for shopping or entertainment. As a result, demand for many products fall, leading to lower revenue for businesses. And the last one, supply-side policies. Supply-side policies are government action designed to make businesses more efficient and productive. They focus on improving the overall ability of firms to produce goods and services at lower cost and higher quality. Privatization means transferring government-owned business to private companies, which usually aim to operate more efficiently. Private firms often invest more in technology and customer service because they want to increase profits. Training and education raise the skill level of the workforce, helping employees work faster and with fewer mistakes. A more skilled workforce increases productivity, which helps businesses lower their costs and improve product quality. Increased competition happens when the government removes barriers and allows more companies to enter the market. When more firms compete, businesses must innovate, reduce prices, and improve quality to attract customers. And now let's look at how businesses respond to economic policy. High taxes. When taxes increase, businesses may reduce production costs or produce cheaper alternatives to maintain customer demand. They may also lower prices to stay competitive. High interest rates. Businesses often delay or cancel expansion plans when interest rates rise. Some firms may sell assets to reduce debts and maintain cash flow. Increased government spending. Companies may compete for public contracts related to infrastructure, education, or transport projects. They may also expand capacity to meet higher demand for government-funded activities. And the last one, increased tariffs on imports. Business may switch to local suppliers to avoid higher import costs. Some firms will also improve product quality to compete with foreign products. This is the end of chapter 27, and I hope the explanation helped you understand how economic issues affect businesses. I have made full revision videos for the other chapters as well, so visit the channel to continue your complete revision. Bye bye. See you next time.